Okay, so the learning objective number 4 is to prepare partnership financial statement. We mentioned that partnership is a legal identity, okay? It's also a accounting identity. So partnership has to prepare financial statement, but it's not a tax entity. So partnership does not pay tax. Okay, so let's take a look at the statement, the partnership financial statement. Let's take a look at the statement of partners' equity. So on the statement of partners' equity, it explains changes in each partner's capital account and in total partnership equity during the year. Okay, so let's take a look at this example. The name of the partnership is called the Kingsley Company. The title of the statement is Statement of Partners' Equity. And then the time zone is for the year ended December 31st, 2024. So now let's take a look at this information. So we have two partners. One is called S. King. The other one is called R. Lee. And then you have one column to the far right as the total number. So January 1st, 2024, the capital balance is 28,000 for King and 24,000 for Lee. The total, when you add the two numbers together, is 52,000. And during the year, the investment makes some money, $2,000, according to the shareholder, the partnership agreement. That investment goes to King. Probably King has most of the contribution on that. And then during the year, they make money 22,000. And the 22,000 is split with 12,300 to King and 9,700 to Lee. Okay, so you add them up, that's how much the capital accounts balance. And then you're gonna less the drawings because the partners withdraw money from the partnership, right? So for King, they withdraw 7,000. For Lee, they withdraw 5,000. So they don't have to withdraw the same amount of money, right? This probably mainly depend on their personal need, right? So then, as of December 31st, the capital account has a balance of 35,300 for King, 28,700 for Lee, and the total now is 64,000. So the capital, okay, the capital account balance has actually increased from 52,000 to 62,000. The difference is the 12,000. So the capital contribution has increased by 12,000. So the reason for that is they make more money than their withdrawal. So if they make more money, the partnership, then money they earned is more than the money the partner withdraw, then the partnership should have more equity. Their capital contribution should increase. And that is the case in this example. So the partnership interest increased from 52,000 to 64,000. And then let's take a look at the balance sheet. Okay. So for the balance sheet, you can see it's called liabilities, we all know. Okay, so 115,000. This is the assumed amount. Now let's only focus on the partner's equity. So here it's not called equity, right? It's called the partner's equity. And then you have King's capital, 35,300, Lee capital, 28,700, for a total of 64,000. And the total liabilities and the partner's equity is 179,000. So you have to be careful.
Excuse me, Professor.
Yeah, go ahead.
The 64,000, the total is the drawings, right, from the partner's equity.
Yeah, so the 60,000, 64,000 is the ending balance of the capital account. The withdrawal, total withdrawal is 7,000 plus 5,000 is 12,000.
Oh, that's the remainder after
Yeah.
the draw.
So
Okay.
yeah, because this is the balance sheet, right? So we want to know the ending balance of the equity, right? The ending numbers are presented, right, on the balance sheet.
Okay, thank you.
But the drawings are actually only 12,000. Yeah. So does anyone have any questions about this? Okay, so let's move on. Okay, so this one is the fifth learning objective. Okay, in this learning objective, we are going to consider the admission of a new partner. When you have a admission of a partner, this will cause the legal dissolution of the existing partnership and the beginning of a new partnership. Okay, and you remember, right? I mentioned that the partnership is really the most important document is that partnership agreement, right? So it is agreed by all partners. So when you have a new partner in, right? So does that new partner agree with all the clauses, the sentences on the agreement agreed by the other partners, right? So what if they don't agree? Then you can't attract this new partners joining you, right? So the idea is when there's a new partner, the existing partnership will be dissoluted. And then with new partner, now they have a new partnership agreement. Okay. There are two ways to get a new partner. So first, let's see an existing partner wants to retire. This is very normal for an accounting firm. So if that partnership wants to retire, okay, so then that partnership will just sell his partnership interest to the new partner. Okay. So they won't affect any other partners. It's just the partner who's retiring, right? Sell his partnership interest to a new partner. So that will not affect other partners' interest. The other approach is to invest in asset in the partnership. So the new partners will contribute $100 million to the partnership. Okay, so in that case, the new partner is not buying from the existing partnership. He's just joining as a new partner with his contribution. So in this case, when you have more asset, more contributions coming in, so the partnership net assets total capital will increase. So you could purchase retiring or some partners, they decide to leave the partnership, you could buy their interest. Or you can buy from maybe two partners wants to retire, right? It doesn't have to be one-on-one. It could be multiple partners. And it's not gonna increase, right? It's not gonna increase the partnership's net asset or capital, right? Because there's no increase. It's just switch hands, right? So from this partner to this partner, right? It switch hands. In total, there's no increase, right? And the investment, the second way is that when the new partnership is not buying from the existing partner, he's just making new contributions. In that case, partnerships asset will increase, capital will increase. Okay, so let's take a look at one example. Suppose the old partner's capital balance is 120,000. Okay. And this gentleman paired 72,000, Huang 48,000. Together, that is the 120,000. So these are the all existing two partners. And the profit ratio is 60-40. So if you earn $100, the Pert will get $60 and Huang get $40. Now we have a new partner. His name is Trent. Trent wants to purchase 25% share of the partnership. The first situation, he paid $80,000. The second situation, he paid $20,000. Okay, so let's take a look. Let's take a look. So right now you have 120,000. Let's take a look at the first scenario. If Trent, right, Trent pay 80,000. So that add 80,000. So the total capital balance of the partnership, right, should be 200,000. Right? That's the total capital balance. And now we know Trent purchased 25%. So the $200,000 is actually the partnership, but only 25% belong to Trent. So 200,000 times 25, I have 50,000. 50,000 capital balance. Okay, so then the question is, well, Trent will say, I paid $80,000. How come I only have 50,000 capital? What about the $30,000 difference? Right, because I paid $80,000, but when I calculated my interest is 25% of the 200,000, it's only 50,000. So where is the other 30,000? The other 30,000, is the bonus to the old shareholders. So this one is a bonus to these two people. Okay, so 30,000 and in total goes to Pert and Huang. And what is the profit ratio. We know this one is 60%. This one is 40%. So for PERT, this bonus, the bonus for PERT is 30,000 times 60%, which is 18,000. For Huang, 30,000 times 40%. So that's 12,000. Okay. So that's what happened, right? That is what happened. So basically, when Trent was buying, there is a goodwill, right? He decided to give a bonus in order for allowing him to join the partnership. He gave bonus to the old partner because it's a good partnership. Does this make sense? Okay. Now,
Yes.
good, thank you. Now let's take a look at the second scenario. What if it's not 80,000, right? What if it's not 80,000? It's 20,000. So if it's 20,000, so we start with 120,000, right? We start with 120,000. And then we add the contribution from Trent, 20,000. So I get 140,000. I still own 25%. Trent owns 25% of the interest. So 25% of 140,000. So that's gonna be, let's see, 35,000. Yeah. Okay. So basically, Trent has a capital account balance of 35,000. Okay. So now we know that Trent only paid for 20,000. If you paid only 20,000, how come your contribution account balance is 35,000? It's actually $15,000 more. Why? So this is the bonus provided by the previous partner. So the previous partner wants to encourage Trent to join in the partnership. So give him a bonus. So bonus doesn't have to go always from the new partner to the old partner, right? It could also go from the old partner to the new partner, right? Depending on who has the power, right? If the partnership is good, very valuable, very promising, so most likely the new partner will pay bonus to the old partner. But if the partnership is not that attractive, right? Or maybe the new partner have some special talent. The old partner really wants to retain him. So they have to give him a bonus, right? So that $15,000, 60% coming from PERT, 40% coming from Huang. Does this make sense? Okay. So this is just the calculation. So first you calculate the total capital of a new partnership. And this new partner only have 25%. So his capital is only 50,000. but he paid $30,000, right? So only 50,000 is contribution. The other 30,000 is a bonus to the other partnership, to the other partners. And you allocated that bonus based on the profit ratio, 60 and 40. So this is my first scenario. My second scenario, my total capital starting with 120,000, and the cash paid by Trent is 20,000. So in total, you have 140,000 capital. Trent owns 25% of the capital, so that worked out to be 35,000. But you only make a cash payment of 20,000. How can you have a capital contribution of 35,000? Because the difference, 15,000, is a bonus from the old partner. Okay. So we are okay with this. Let's move on to point 6. I need to stop here.